what they're doing is they're kind of holding the ship steady here, kind of hinting that the next meeting might be, and then it'll be the next meeting. But I don't see a meeting anytime in the near future in which you're going to raise, because as we're seeing now, even by the earnings that are coming out, we're not seeing the true growth that they're looking for. We're not getting the inflation they're looking for, because they are actually, by their actions, are putting the throttle on the overall economy.
And I guess we've also seen a whole flurry of economic data coming out of the US today. We saw durable goods orders, consumer confidence falling, that not really providing any positive, I guess, signals for the US Fed. How much is that likely to play into their decision?
I think that'll play into their statement when they say that they're not going to raise rates. But I believe that they don't really know where they want to go. I believe that they have painted themselves into a corner and can't really get out. And because of the currency wars that we're seeing throughout the globe, our interest rates here, although they haven't touched them, are still the highest in the world, because you see all the currencies floating lower. So it creates a much bigger problem going forward, and that's a problem that they did not address. So I think they're using the information of the data, saying, hey, we can't raise because of, but really I think it's the fact that they painted themselves into a corner, and they're too worried about the equity market, which should really be the least of their worries.
Hi, it's Gaurav Sodhi in Sydney here. There are quiet voices now suggesting that perhaps stimulus might be the next move rather than tightening. What do you think about the likelihood of that occurring?
Well, I've been actually stating for quite a while now that I would expect to see a QE4. I think that, again, this goes back to the whole model. If you look at what they've done with the continue of pouring money in, they really haven't brought growth back. We have a lot of companies making a lot of money because they have the ability to take that cheap money and buy back their own stock, buy other companies. But when it comes to actual growth, when it comes to actually putting people back to work, we are not creating good jobs. So no matter what the jobs number is Friday, it's going to be a lot of minimum wage service jobs, which is not the answer when you have a population between 45 and 65 that were industrial workers that aren't working, that aren't making any money. The middle class is still in a recession, earning 9% less today than they were just 7 years ago.
I mean, you mentioned that economic data being weak there and concerns about the stock market as well, but we're also seeing, of course, both China and Europe heading for more quantitative easing. We're seeing these deflationary pressures also building, so some suggesting that we can actually, you know, as you suggest, I guess, be fairly confident that a rate rise won't happen until at least next year.
I am as confident as I could be. I've been on this the entire time. I don't see them raising rates, but I think it's more from a fear factor of worried about what the equity market was, because the truth is their mandate is not to worry about the equity market. It was supposed to be the lender of last resort, and we've now bailed out the banks for 6 years, and we have not provided liquidity to the middle class, which has taken away entrepreneurship. It's taken away the ability for the individual to loan and borrow money, because the banks, why would they want to loan out when they can give it back to the full faith and credit? So they've created a lot of this mess on their own by not taking action sooner. And when Bernanke in 2013 decided not to raise rates and let the Wall Street take over, that was the last real good opportunity that they had.
If we take a look at the market moves that we saw today, Todd, certainly seeing it still in negative territory at the moment. Oil price is very much weighing, but also, I guess, a lot of caution ahead of the Fed's decision. What have you made of some of the moves on the market today?
I think when you look, there's a couple of key things to look at. First of all, we've been very choppy the last 2 days, you know, around the flat line. But the NASDAQ has been exceptionally strong, and really exceptionally strong since that August 24th bottom. The NASDAQ is up 22% from that bottom. But the bigger story to look at is, although the NASDAQ is higher today and the S&P and Dow are flat, the Russell is getting hammered again and threatening to go down to the lows again, which to me is a very bad sign for the overall economy, because that's really the American small business, and they're having a lot of trouble dealing with this. So I think we'll see kind of what the Fed says tomorrow. I would expect a big rally because they're not going to raise, but I think you want to look for a much bigger sell-off after the rally.